Hey everyone, welcome back to Corporate Decoder. Today, FundVantage Trust P.L.C. just filed for their N-CSR report, and I am seeing some interesting trends in their ETFs. Quick note, this is not financial advice, just my take on public filings for educational purposes. The report gives us a snapshot of 3 of their funds' performance and their investment holdings up to the 30th of April, 2026. So FundVantage Trust P.L.C. oversees a few different investment funds, and this N-CSR filing is basically their annual report to shareholders. It lays out how each fund performed, what they invested in, and some key financial numbers. We're going to dive into the details for their Polen Floating Rate Income ETF, Polen High Income ETF, and Polen Focus Growth ETF to see what story the numbers tell. Let's start with the Polen Floating Rate Income ETF. For the year ending the 30th of April 2026, this fund saw its net assets grow from about $8.8 million to just over $9.4 million. That is a pretty good increase, showing that investors are putting more money into it. The report highlights that its total return for the year was 4.05%. This might sound a bit low, but keep in mind this fund is all about income and capital appreciation, and it is compared against benchmarks like the Morningstar LSTA US Leveraged Loan Index, which returned 6.22%. So it slightly underperformed its benchmark for the year, but it's since. Inception return is a solid 7.49% as of the 30th of April 2026. That is important because it means over the longer haul it has been doing quite well. Looking at its holdings as of the 30th of April 2026, this fund had 122 different investments. The bulk of its money, about 82.3%, was in senior loans. This is where the floating rate part of its name comes in. These are loans where the interest payments can change based on market rates, which can be good when interest rates are going up. We see significant investments in sectors like consumer discretionary products and services, healthcare, and industrials. For instance, it held about 3% in consumer discretionary products with positions like AI Aquamerger Sub Inc. And in healthcare, it had a significant 12% allocation. With holdings like CVA to Midco 2LP, the total value of its investments was over $9.4 million. Next up is the Polen High Income ETF. This fund is a bit newer, starting operations on the 25th of March 2025. For the year ending the 30th of April 2026, it generated a total return of 6.69%. This fund is designed to provide high income, and it is benchmarked against the ICE-BOFA Yield Index, which returned 7.66% for the year, meaning it also slightly underperformed its benchmark. However, its net assets grew substantially from about $12.9 million at its start to over $22 million by the 30th of April 2026, which is a very strong growth. As of the 30th of April 2026, this fund held 136 different investments, and its strategy leans heavily into corporate bonds, making up nearly 89% of its portfolio. This is where the high income part comes from, as corporate bonds, especially those with lower credit ratings, tend to offer higher interest payments to compensate for the increased risk. We see substantial investments in consumer discretionary products and services, healthcare, and industrials. For example, in consumer discretionary products, it held over $1.3 million in companies like Adient Global Holdings Limited and Beach Acquisition Bidco, LLC. The report also touches on fund costs. For the Polen Floating Rate Income ETF, the total advisory fee paid net was about $46,000 for the year, which worked out to about 0.49% of the fund's value. For the Polen High Income ETF, the net advisory fee was around $106,000 or 0.53%. These fees are important because they directly impact the returns investors receive. While these percentages might seem small, over time they can add up. Now, let's look at the Polen Focus Growth ETF. This is the newest of the 3, starting operations on the 30th of September 2025. So, its reporting period is quite short, from the 30th of September 2025 to the 30th of April 2026. During this period, the fund actually saw a negative total return of 11.23%. This is a significant drop, and it underperformed its benchmarks, the Russell 1000 Growth Index and the S&P 500 Index. The report mentions that stock selection in the information technology sector was a primary detractor, particularly from software exposures, and healthcare also presented a headwind. The fund sector positioning, especially its overweight in financials, also hurt its relative performance. As of the 30th of April 2026, this fund had net assets of over $98 million and held a relatively concentrated portfolio of just 26 common stocks, which is typical for a focused growth strategy. The top sectors here are information technology at 36%, followed by financials at 16.2% and healthcare at 13.8%. This strategy aims for long-term capital growth by investing in a select group of companies with sustainable growth potential. Looking at the financial highlights, we can see the per-share performance for the Polen Floating Rate Income ETF. The net asset value ended the year at $22.90. For the Polen High Income ETF, it ended at $24.55. However, for the Polen Focus Growth ETF, the net asset value ended the period at $22.23. Down from its starting point of $25.05, reflecting that negative performance. The report indicates that the Focus Growth Fund experienced some challenges in its initial months. The total investment return figures provide a clear picture. The Floating Rate Income ETF had a 4.05% return for the year. The High Income ETF had 6.69%, and the Focus Growth ETF had a significant negative return of 11.23% in its short period. It is crucial to remember that past performance is not a guarantee of future results, especially for newer funds or those in volatile market segments. The filing also details how investments are valued. For the most part, investments are valued using quoted prices in active markets, which is pretty standard. However, for some corporate bonds, especially in the Polen Floating Rate Income ETF and the Polen High Income ETF, there is a significant portion classified as level 3 investments. This means they are valued using significant unobservable inputs, often based on models or recovery analysis, because active market quotes aren't readily available. For example, in the Polen Floating Rate Income ETF, about $282,000 worth of corporate bonds are level 3. Similarly, for the Polen High Income ETF, a larger amount, around $598,000 is in level 3 corporate bonds. This classification points to a higher level of uncertainty and subjectivity in valuing these specific assets. The report mentions a recovery analysis for these level 3 assets, with a weighted average recovery value of 86.06%. This suggests that even though there might not be active market prices, there is an estimated value based on what might be recovered if the issuer defaulted. It is important to note that 10% of this valuation was still based on observable inputs. This highlights a key risk in funds holding these types of assets. Their true value can be harder to pin down. For the Polen Floating Rate Income ETF, there is a mention of unfunded loan commitments. As of the 30th of April 2026, they had about $20,000 in unfunded commitments. This means the fund has agreed to lend money in the future, but hasn't done so yet. While it is a small amount here, it is a part of the floating rate strategy. The filing also confirms that the trust has adopted a code of ethics that applies to its top executives, and that there have been no waivers or amendments to this code during the reporting period. This is standard practice, but reassurance that the company maintains internal ethical guidelines. When it comes to the financial statements, the report details fees paid to independent accountants. PricewaterhouseCoopers LLP received significant fees for audit and tax services, over $320,000 for fiscal year 2026. Cohen & Company Ltd also provided services, primarily for audit. These audit fees are pretty standard for funds of this size and complexity, and it is good to see that the audit committee has policies in place to ensure auditor independence. The notes to the financial statements also bring up restricted securities. These are investments that can't be easily sold on the open market. For the Polen Floating Rate Income ETF, they held restricted corporate bonds valued at around $282,000. Similarly, the Polen High Income ETF had restricted corporate bonds worth roughly $598,000. These are classified as level 3 investments, which, as we discussed, carry higher valuation risk. Looking at the overall performance trends, the two income-focused funds, Floating Rate Income and High Income, show solid net asset growth and income generation. Though they slightly trailed their benchmarks for the reporting year, the Focus Growth ETF, however, had a challenging start with a notable negative return in its initial period. This highlights the inherent risks in growth investing, especially in sectors like technology, which can be quite volatile. Overall, the filing gives a clear picture of the different strategies employed by these three funds. While the income-focused funds show stability and growth, the Focus Growth Fund is still finding its footing with a difficult start. The reliance on level 3 valuations for certain corporate bonds in the income funds is a point to watch for any investor, as it introduces a layer of valuation uncertainty. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. See you next time.